Today is May 11th, 2025. All three indexes have seen major bounce off the early April bottom in the last few weeks. Is the recent rally real? Or is it just a bear market bounce? That's always a question investors have when the market is rising after a significant sell-off, especially now given all the uncertainty regarding tariffs and worries about the economy. While the S&P 500 sell-off, from its record close of 6,144 on February 19 to its one-year closing low of 4,982 on April 9, on Friday, the index closed 13.6% above the recent low, which is also a rally strong enough for investors to question whether a new uptrend has started. This is where the magical Fibonacci ratio of 0.618 comes in. For the S&P 500, the 61.8% retracement of its 1,161-point drop, on a closing basis, to the April 9 low comes in at 5,700. Since Fibonacci levels offer a point of reference during uncertain times, they often provide resistance on the way up and support on the way down. On May 2, the S&P 500 coincidentally reached an intraday high of 5,700, before pulling back to close at 5,686. The S&P 500 closed Friday down at 5,660. All that means is the index is still just bouncing, and the downtrend is still alive. Meanwhile, levels on the downside to watch include previously surpassed Fibonacci retracement targets of 50% and 38.2%, which come in at 5,563 and 5,426, respectively. The 38.2% Fibonacci is more likely to act as support, since it seemed to cap the market's first attempt at a bounce between April 9 and April 15. Among the other major market indexes, the Dow Jones Industrial Average has retraced just 49% of its sell-off at Friday's close, and needs to climb another 2.3% to get to the 61.8% target of 42,200. The Nasdaq Composite has retraced 54.2% of its downtrend, and needs to rise 2.1% to reach its Fibonacci of 18,300. So we'll be watching if the indexes can clear their magic Fibonacci numbers next week to start the real trend reversal.